Welcome to The Explainer. Today, we're diving into something that seems simple, but is actually, well, it's pretty weird. We're talking about how life insurance companies really make their money and how they figure out if they're winning the most high-stakes bet of all.
You've probably heard this saying before, and for us, the customers, it's spot on. We're paying for a parachute we hope stays packed forever. We're buying peace of mind, plain and simple.
But just flip that coin over for a second. The insurance company is on the other side of that bet. And for them, figuring out if they're actually winning isn't as simple as, just checking the bank account at the end of the year. It's way more complicated than that.
To really get how their world works, we have to start by throwing out the single biggest misconception about how these companies figure out their profits.
Yeah, most of us think it's just simple math, right? Premiums come in, claims go out, and what's left is profit. But no, that is completely wrong. In fact, if you ran an insurance company that way, you'd go bankrupt, fast.
The real key, the secret sauce, is this concept with a pretty dramatic name: death strain at risk. And what's wild is that it's not really about the claim itself, but about the shock that claim sends through the company's finances. Here's how to picture it. The sum assured, that's the big check they have to write your family. The reserve is like a tiny piggy bank they've been saving up just for your policy. The death strain, that's the enormous gap they have to fill between the two.
So let's use the example here. If you have a $100,000 policy, but the company has only managed to save $2,000 in your little reserve piggy bank, the death strain is a massive $98,000. That's the cash they have to yank out of their own capital to pay the claim.
Okay, get ready because this next part is truly mind-bending. For an insurance company, saving money is actually an expense. I know, that sounds totally backward, right? When we save money, our net worth goes up. For them, it's the opposite. And here's why. That reserve, it isn't actually the company's money to play with. It's a liability. It's a pot of cash that legally belongs to future policyholders. So every single dollar they move into that reserve is a dollar they cannot count as profit. It's just like paying a bill.
And this idea, it completely flips the script on their business model. Profit isn't made when their predictions are perfect. Oh no, profit is made when reality turns out to be different from their plan, in a good way for them.
Let's look at this case study to see it in action. Okay, an insurer has 10,000 policies. Their models predict that 1% of those people, so 100 people, will pass away this year. That creates an expected financial strain of $5 million. That's their plan.
But, life happens. Or in this case, death doesn't happen quite as much as the spreadsheet predicted. As you can see, in the real world, only 89 people passed away. Their prediction was wrong.
And that's it. That's the profit. That difference, the 11 people who didn't die, means the company avoided the strain it was expecting. That little gap between expectation and reality, that created a $550,000 mortality profit.
But, and this is a huge but, this game cuts both ways. For life insurance, the company profits when you live longer than expected. But for an annuity, which is a product that pays you an income until you die, the whole thing is flipped on its head. In that case, the same outcome, people living longer, creates a massive, massive loss.
All right, if you thought that was weird, prepare for a real head-scratcher. How on earth can an insurance company lose a fortune when someone dies, even when they don't have to pay out a single penny in claims?
So here's the riddle. You've got what's called a last survivor policy on a couple. It only pays out when the second person dies. Okay, so the first person passes away. The insurance company doesn't write a check. Nothing happens.
So your gut reaction is probably, no, of course not, right? No money left the bank, so no financial impact. Wrong. In the bizarre world of insurance accounting, a huge financial strain was just created. An invisible shockwave just rattled the company's balance sheet.
So, how is that possible? Well, it all comes back to that reserve. When both people in the couple were alive, the odds of a payout were really low, so the reserve was tiny. But the second one of them dies, the policy's risk profile completely changes. Now they're insuring just one person, and the odds of a payout just skyrocketed. So they have to immediately move a big chunk of their own capital into that policy's reserve to cover the new, higher risk. And that internal transfer of money is the strain.
And of course, in the real world, it gets even more complicated. You see, actuaries don't just see people as alive or dead. They see us as constantly moving between different states of being, and each state has its own cost.
Look at this model here. It's a simplified version, but take something like disability insurance. You can be in the healthy state, which is cheap for them to insure. Then you could move to the sick state, which is suddenly very expensive. They might have to pay you every month. Then you could move to the dead state. But here's the kicker. You can also move from sick back to healthy. It's a constant flow.
Okay, so what? Why does any of this super complex math matter to you, the person who's just trying to pay their premium on time every month?
This quote absolutely nails it. Your premium isn't just some random fee. You are literally paying rent on the giant pile of money the insurance company is legally forced to lock away, just for you to cover your potential death strain. If you're higher risk, they have to lock away more capital, and so your rent, your premium, goes up.
So the next time you look at your insurance policy, remember this. Somewhere out there, an actuary has calculated, down to a tiny decimal point, the probability of you changing your state tomorrow. And the real question I want to leave you with is, do you think their bet on you is a good one?